Hi guys, welcome back to the channel. Hope you're doing good. It doesn't matter if the market goes up or down, I'm always looking for good companies that can each offer something different. And this month is no different, where I've lined up 3 UK stocks which look like good long-term options. Stock number 1 is Legal & General. Chances are that you've heard of this company in some shape or form. They specialise in savings management, with net sales are broken down with 79% of its revenue coming from asset management under index funds and securities, alongside mutual investment funds, with 1.4 billion of assets under management in 2021. 13% of their business is through life insurance and retirement savings management, with 4% in non-life insurance and 3.4% coming from other areas. This is a company which has an element of safety to it due to its diversification and having a very nice dividend to offer. It's not a company that's going to go up 20% each year, but it can be a cornerstone in an income-focused investor's portfolio. Revenue from 2017 up to 2021 has varied. It had doubled revenue from 8 billion in 2017 to 15 billion in 2019, but profits still remained fairly flat at around the 2.3 billion mark. Of course, the pandemic has affected this company, as it has with the most, with revenue last year coming in at about 10.3 billion, but profits surged to 2.9 billion, the highest it's been in over the last 5 years, which is really good to see. Even as the stock market crashed in 2020, Legal & General were still able to pay an enormous dividend that was covered by earnings. This dividend payment has been growing from 15.35 pence per share to 18.45 pence per share last year. As the earnings and profits recover, this dividend looks safe, with the potential of gradually increasing over time. Cash on hand is about 16.5 billion, pretty much in the middle of where it's been over the last 5 years. Total assets have increased from 504 billion to 582.64 billion, alongside total liabilities increasing from 497.6 billion to 571.7 billion, and net assets now at 11 billion, the highest it's been in the same 5-year period. Recent results show that Legal & General reported a jump in 2021 profit, and it lifted its dividend as it benefited from a post-pandemic economic recovery and the easing of restrictions. Full year pre-tax profit rose 39% to 2.49 billion, while profit after tax was up 28% to 2.05 billion, exceeding 2 billion for the first time. Earnings per share were 72% higher compared to 2020 at 34.19 pence and 19% above 2019. Operating profit was 11% higher in the year at 2.25 billion, which is consistent with double-digit guidance provided at the first half results. Solvency coverage ratio was 187%, up from 175% a year earlier. The company's return on equity came at 20.5% versus 17.3% the year before, and Legal & General declared a full year dividend of 18.45 pence, up 5% on the year. All this information can clearly be seen here in this presentation, with all areas reporting strong numbers across the board. Legal & General have numerous divisions, each individually contributing to the group's results. LGRI, the retail investment groups, is the largest, and it did actually have a 6% drop in earnings. Legal & General Capital reported a huge 68% growth, and the rest of their groups, investment management, retail, retirement and insurance, all reported good numbers. This blue chip company has been able to increase its operating profit at a combined annual growth rate of 9%, earnings up 11%, dividend per share 11%, and book value per share 7% over the last 10 years, really emphasising how consistent and well run this company really is. Within LGC, which reported the highest growth, they have ambitious targets and strategies to promote growth. They own Cala Homes and want to build 4,000 homes over 5 years to generate 1.7 billion in revenue and 270 million in operating profit per annum. Likewise, they want to build over 3,000 affordable homes. Their profits have grown from 1 million in 2019 to 26 million in 2021. They have joint venture with PGGIM, with involvement in 11,000 homes, with a gross domestic value of 3.8 billion. And lastly, with Pemberton, assets under management has grown 10x from 1 billion in 2016 to 11 billion in 2021, with ambitious plans to grow this from 11 to 27 billion. Reporting 100 million in EBITDA, all within 5 years. As of right now, Legal & General share price is about £2.74, giving it a market cap of about 16.41 billion. The share price is pretty flat within the last year, and it's been recovering since the sell-off at the start of this year. It does offer a really strong dividend, yielding currently about 6.5%. As I said, this company won't be going up crazy amounts each year, but with a safe growing dividend, it can still offer fantastic overall results over a period of time. TipRanks has a price target on this one of £3.44, giving 25% upside from current levels with 5 buy ratings and 4 hold. Stock number 2 is Rentokil Initial. Rentokil are one of the world's leading service providers to companies. The majority of their revenue comes from its distribution of sanitary hygiene and rodent and insect extermination products. 26% of its revenue comes from cleaning and catering for schools, hotels, airports, healthcare facilities and the likes. 12.5% of its revenue comes from manufacturing, selling and rental of work clothes, and provide laundry services to restaurants, hotels, hospitals and much more. They're a company which, unlike many, were actually able to increase revenue through the pandemic. Revenue has been steadily growing from £2.4 billion in 2017 to just under £3 billion in 2021, with profits mainly following the same direction, growing from £292 million to £346 million. Rentokil also pay a dividend. They didn't pay one in 2019, but out with this, it's been growing from 3.88 pence to 6.39 pence as earnings per share has been increasing over time. Cash at the bank is £668 million. Total assets now sit at £4.3 billion, up from £3.1. Total liabilities has increased from £2.1 to £3 billion at the same time, and the company still has a growing net asset range from £934 million in 2017 to £1.26 billion last year. Rentokil posted a jump in full year profits and revenue and following particularly strong performance from its pest control business. Adjusted pre-tax profit for 2021 rose 22.1% to £416.5 million, with ongoing revenue up 9.8% at £2.9 billion. On a statutory basis, pre-tax profit was up 41.5% at £325.1 million, with revenue 5.5% higher at just under £3 billion. Rentokil highlighted a particularly strong performance from the pest control segment, which saw ongoing revenue growth of 18.6% to £2 billion, boosted by an excellent performance from the North America business. This was slightly offset by weaker performances from its Australia, New Zealand, Malaysia and Indonesia operations, which were still dented by lockdowns in the second half. The core hygiene business, excluding disinfection, delivered an 8.2% increase in ongoing revenue to £555.6 million, reflecting good performances in the UK, Europe and Latin America. Overall hygiene revenue declined by 8.4% to £673.4 million, however, reflecting the anticipated tapering of disinfection services. Part of Rentokil's strategy is to be merging and acquiring similar companies that could be complementary to their business model. In 2021, they acquired 52 businesses, Terminix being the largest. Overall, in 2021, they spent £463 million over these purchases and will add £146 million in revenue. By acquiring Terminix, they will be able to implement synergies with the aim of saving £113 million. Looking into the regional performance, North America had ongoing revenue growth of 14.2%, ongoing operating profit of 8.7%, with net operating margin of 16.7%, with expectations that this will increase to 18% by the end of 2022. Europe reported ongoing revenue of 3.9%, ongoing operating profit of 9.9%, with really good increased margins of 19.2%. The UK and the rest of the world combined reported ongoing revenue growth of 10.8%, ongoing operating profit growth of 48.2%, and huge net operating margins of 24.8% due to a strong rebound in the UK operations. Asia ongoing revenue growth was 5%, ongoing operating profit was down 0.1%, with net operating margins of 10.6%. Recovery was held back by difficult trading conditions in Malaysia, Indonesia, Vietnam and Thailand, as earlier mentioned. In the last area, Pacific has ongoing revenue growth of 8.7%, ongoing operating profit of 9.9%, with a net operating margin of 19.7%, showing good overall recovery within this area. Looking further back to 2014, Rentokil have been able to grow revenue from £780 million to £2.2 billion, with an 8-year combined annual growth rate of 13.5%. By eating up and acquiring the competition, this has really allowed Rentokil to keep top and bottom line growing nicely. A similar story can be seen in their initial hygiene area of the business, with revenue increasing from £348 million in 2014 to £556 million in 2021, recording an 8-year combined annual growth rate of 6.2%. Right now the share price is around £5.16, given a market cap of £9.6 billion. It does trade at a premium PE ratio and it offers a small but decent dividend of 1.24%. Over the last year it's up 5%, but still a good bit off its highs, which were close to £6.50. If you'd been a shareholder 5 years ago, you'd be up over 100% on your position, with any dip being a fantastic time to buy. A price target of £6.15, giving 19% upside from where we are here today. 6 buy ratings, 2 hold and 1 sell. And finally, stock number 3 is JD Group. JD Sports Fashion are a UK-based sports fashion and multi-channel retailer of branded sports and casual wear, combining global brands such as Nike, Adidas, Puma and the North Face. The group operate under various labels such as Foot Patrol, JD Gyms, Tessuti and Go Outdoors, just to name a few. It's a company which aims for the typical younger generation, so more around the teenagers up to late 20s, but they do have a bit of everything for all ages and gender. The growth in JD has been phenomenal, from growing from 2.4 billion to 6.1 billion in 5 years. Profit has been overall growing, but it has been a little inconsistent in recent years, but nonetheless has grown from 240 million to 385 million in the same 5-year period. Earnings per share has also been growing really well, from 3.81 pence to 6.44 pence, with the company also offering a fluctuating dividend. Total assets are up massively in recent years, currently sitting at around 5.1 billion, with a very nice 964 million as cash in the bank, the highest it's ever been. Liabilities have been growing from around 800 million in 2018 to 3.6 billion last year. Net assets are still sitting at 1.5 billion, with the balance sheet still being in pretty decent shape. Unfortunately, we don't have the most recent earnings to go by, as JD's announced a delay to its full year results, but did mention that numbers were set to be slightly ahead of expectations following a continued positive performance in January, with January 2022 and like-for-like businesses were more than 10% ahead of the same period in 2020, with an equally positive performance across Black Friday and the Christmas period. As with the majority of companies, JD has ceased its operations in Russia, and this won't have much of an impact at all, as less than 0.05% of its revenue comes from that region. As stated, recent results aren't available unfortunately, but we can still go through the most up-to-date that we have here to see if there's any long-term information for us to digest. Year-over-year results for the first half of 2021 showed that revenue was 3.8 billion with EBITDA of 554 million, and this is a fantastic increase of 2.5 billion in revenue and 148 million in EBITDA, showing strength in the company's recovery. Looking even further back, we can clearly see that the revenue has been coming on heaps and bounds in the last few years. Fantastic growth reported in North America, where it's grown from 180 million in 2018 to 1.4 billion in July 2021. Getting a breakdown of the profit before tax, the Premium UK and Republic of Ireland are the clear standout, where it brought in 118 million, with Premium North America not far behind at 84 million. One area of concern would be the negative 9.7 million in the Premium Europe aspect of the business. Current share price for JD is just under £1.50, which would give it a market cap of 7.67 billion and a PE ratio of under 18. A small dividend is on offer here at only 0.19% at the moment. JD's share price is down 9% this year, and it's really struggled to get back to earlier highs. Retail stocks in general seem to be having a really tough time at the moment within the market. But looking back longer term, over the last 5 years, as with Rentokil, shareholders from 5 years ago would still be up over 90% on their position. Tip ranks seem to really highly rate this one, with a price target of £2.49, giving 69% upside with 6 buy ratings and 1 hold. And that'll bring us on nicely to the end of this month's video. I hope you've enjoyed it and found some value in it. And thanks again, and I'll catch you all in the next video. Cheers.